is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us.
Hey guys, welcome to Everyday Finance. Ark Invest CEO Cathie Wood warns that the US is facing a debt crisis of historic proportions, having officially reached public debt levels equivalent to World War II. Except this time, there's no global conflict to justify such excessive spending. This rising debt, as a percentage of GDP, indicates a government whose expenditures far exceed its revenues, widening the budget deficit. Wood suggests that this support system is narrow and temporary, despite the economy's apparent health, boosted by wealthy consumers' discretionary spending and COVID-19 stimulus-fueled demand. Former President Donald Trump's renewed talks with Saudi leaders, including Crown Prince Mohammed bin Salman, MBS, to drive down oil prices are signaling geopolitical jockeying to stabilize or influence markets. Mainstream inflation metrics may show cooling trends, but alternative data providers like Trueflation suggest a deeper economic malaise as prices fall more than reported. This price drop, combined with declining economic momentum, may indicate systemic stress, signaling a fundamental economic engine failure. Washington's political discourse focuses on tax cuts and deregulation, ignoring the possibility that these measures may not be sufficient for the unique challenges ahead. Under the rhetoric, Wood implies that policymakers are quietly preparing for a more destabilizing event, possibly a collapse. Wood suggests that disruptive innovation, or structural changes in how economies function and grow, could define the next era of markets as the video progresses, offering a glimpse of what lies ahead once the debt-fueled cycle unravels. Let's watch the interview.
Other evidence of rolling recession. The green line here is the manufacturing PMI, and you can see it started going down even before rates went up in 22 in response probably to too much inventories built during the supply shock when companies were double and triple and quadruple ordering. And you can see this measure has been below 50, which means the manufacturing sector has been contracting in the U.S. For several years. It popped up 1 month and now is coming back in. The purple line here is U.S. Manufacturing as a percent of GDP. And you can see one of the reasons President Trump is determined to bring manufacturing back to the U.S. Many people say it'll be a fool's game to do that because compensation costs here are so much higher and it will just feed inflation. We have a different point of view on that. We believe that automation with robots, soon more and more humanoid robots, AI, is going to be fertile ground to bring manufacturing back. In fact, it reminded, as manufacturing here in the United States was being gutted, and it went to China, we began to think, okay, how could this reverse? Well, if you think about what happened to China in telecommunications, it did not have a landline system. So it went directly to wireless and became a mobile-first economy, and also leapfrogged us in the digital wallet space. Again, mobile-first. Our financial rails were good enough. It did not have a physical bank branch system. And so it went directly to mobile first. And leapfrogged us. We're just now moving more into mobile payments in a big way here in the U.S. and in other countries. Well, what if the payback for the last 25 years of losing manufacturing is we leapfrog China and other countries who have older manufacturing techniques that are more labor intensive and go straight to automation, significant automation, and really it is something we expect, and we do think it will drive significant productivity in the years ahead. So we're more hopeful on that score, to be sure. And more on the rolling recession here. This is year-over-year change in capital goods. It's new orders for non-defense equipment, aircraft and parts on a year-over-year basis. It took a while, but the capital spending has been going nowhere. It's been flat for a good year. And if we're right, given all the uncertainty out there, it could tip over here. So this one is feeding into that rolling recession argument as well. Now we're on to more market indicators. So Bloomberg's commodity price index. We did this chart. Earlier this week. I think the Bloomberg commodity index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us.
The debt-to-GDP ratio is now at World War II levels, and there's no post-war economic renaissance to save us. In the 1990s, robust economic growth and genuine bipartisan cooperation led to budget surpluses. Today, dysfunction, partisanship, and fiscal gimmicks prevail. The political system is paralyzed, and the strategy is reckless tax cuts and wishful thinking. As inflation data becomes unreliable and contradictory, clarity is lost. Saudi Arabia deliberately floods the market, causing oil prices to plummet, and consumers are financially exhausted after years of economic pressure. Commodities have fallen to levels not seen since the early 2000s, signaling deflationary pressures in key sectors. In this context, gold has quietly gained strength and signaled a global flight to safety, while Bitcoin, often hyped as digital gold, loses steam, revealing cracks in the crypto narrative. Treasury yields, once stable, are now below 4%, artificially supported by $250 billion in stablecoins, another sign of monetary manipulation and system fragility. More alarmingly, yields have broken their 40-year downtrend, a technical and psychological shift that suggests a new economic era. Cathie Wood, known for her forward-thinking insights and focus on disruptive innovation, sees this as a deep structural shift that could change macroeconomics. She warns that rapid, tech-driven deflation may render growth, inflation, and central banking obsolete. AI, automation, and decentralized finance could drive costs down so fast that our debt, monetary policy, and investment systems may not be able to adapt. This is a paradigm shift into uncharted economic territory, not just a market correction. Wood believes those who embrace innovation, adaptability, and a willingness to rethink modern finance will succeed, while the establishment clings to old tools and policies. In her video, she explains how these transformative forces are already underway and will only intensify, creating a new market cycle that is completely different from the past. Watch the video.
Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities, and from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now. And there's also another phenomenon. I don't know how much it would have an impact on this, but the stable coin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold, and as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gov of GovCal is monitoring, and he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield, we did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5%. But clearly the burden of proof is on us on that one.
Historically, transformative innovation has been sown during deep financial uncertainty, as we are seeing now. We're again at the brink of a major economic and technological shift. Just like in 2008, when the global financial crisis and widespread fear forced tighter budgets and spawned disruptive models in finance, technology, and mobility. Long-term investors like Cathie Wood know that true innovation surges forward in times of chaos, often planting its flag before the recovery begins. This pattern is repeating as we enter another economic era with record public debt, political gridlock, and institutional stagnation. Technologists, entrepreneurs, and decentralized thinkers are building the next major transformation from the ground up, unlike past recoveries led by central banks or top-down policy decisions. Another crypto boom is underway, this time with more focus. Fiat-pegged stablecoins are leaving niche crypto ecosystems and becoming mainstream. As regulatory frameworks develop and Apple or Amazon integrate stablecoins into their platforms or payment systems, the financial landscape could rapidly change, changing how people store value, transact, and interact with global markets. In this environment, innovation is the only way forward. Inefficient bureaucracy, outdated models, and reactiveness hinder traditional finance. Developers in fintech, blockchain, AI, and other emerging sectors are testing, iterating, and preparing to reshape core banking and international trade systems. Not just technology, this is about rewriting participation, power, and possibility in a world that needs new direction. According to Cathie Wood and other visionaries, this is the moment when disruptive technology will rule finance and society. While the world waits for political solutions that may never come, those paying attention know the next big wave is forming quietly, quickly, and outside conventional control. The video shows that the real takeaway isn't data or forecasts, but awareness. Builders are already building, and the future won't wait for permission. Thanks for watching.